Welcome to Accounting with Audra. In this video, we will continue to broaden our understanding of ASC 740 by looking at uncertain tax positions. In the first 3 videos regarding accounting for income taxes, I explained how companies record income tax payable for their current year tax return liability and income tax expense for taxes that relate to book income in the current year. Variances in book and tax rules are also generalized using deferred tax assets and liabilities. But what happens when a position taken on a tax return is subject to interpretation? And it is possible that if the issue with regards to such position taken comes under audit by the IRS could be challenged. ASC 740 requires that the income statement impact of such tax positions potentially should not be recorded in the audited financials. This video will discuss a 2-step process required by taxpayers for recognition of an uncertain tax position and its measurement so that its impact may be recorded and reflected timely in the financial statements. Under ASC 740, recognition and measurement are considered discrete events. The recognition threshold is met when an entity concludes that there is a greater than 50% likelihood that a tax position based solely on its technical merits will be sustained upon examination by the appropriate taxing authority. Tax positions for this purpose only relate to taxes on income, similar to the other components of ASC 740. So what does this mean? Assume a taxpayer files its tax return, and on that current tax return includes a deduction in which the existing statute and supporting resources do not directly address. The taxpayer in this instance must evaluate whether on audit such an expense would be more likely than not to be sustained. In conducting this analysis, management must assume the IRS agent reviewing the issue has access to all known facts and circumstances. Past audit history and likelihood of this issue being identified may not be considered when determining whether or not a UTP should be recognized. Assuming management ascertains that there is a greater than 50% chance that this specific deduction would not be allowed, in other words, the more likely than not criteria is not met, the taxpayer is required to make a journal entry that reverses the impact of the deduction on the financials. Step 2 is then quantifying just how much of an offset should be booked. The value of the UTP could be 100% of the benefit taken, but often it's measured at a completely different amount. Only the tax benefit that is cumulatively greater than 50% likely to not be realized should be adjusted. This is accomplished by utilizing a probability table. Let's say, for example, the deduction in question pre-tax is a $10 million deduction. Management determines after evaluating all the facts and circumstances that the likelihood that the full $10 million would be sustained is only 10%. However, they also determine that it is 25% more likely that an $8 million of that benefit could be sustained, an even higher likelihood, in this case 30% more likely, that $6 million of the $10 million benefit would be sustained, and 35% more likely that $4 million would be sustained. The amount of the benefit that should be realized in the financials should be any amount that may be sustained above 50%. Looking at cumulative probability for each amount of benefit, it is more likely than not that $6 million of the benefit may be sustained upon audit, as management has determined this amount to be greater than 50%. In our case, it's 65%. Thus, the difference between the full benefit of $10 million and the amount that is more likely than not to be sustained of $6 million gives us a $4 million value that should be recorded as a contingent liability, so that the financials include, instead of a $10 million benefit, truly only $6 million of the benefit. In order to record the liability, the company should record a debit to income tax expense to reverse the benefit for $4 million and record a credit to a new account labeled liability UTP. This liability remains on the financials until one of 3 things happens. The company is audited and settles on this item. At such point in time, the UTP is removed, incremental benefit or expense is recognized. Or statute of limitation for the return year the UTP relates to has closed, resulting in the removal of the UTP and then again a recording of a benefit. Or new facts result in the need to remeasure the amount in the financials. In such a case, there could be a debit or a credit to the liability and then an offsetting debit or credit to income tax expense or benefit. Companies may have any number of UTPs, depending on various positions they decide to take on a tax return. They are required to keep a running reconciliation of their cumulative UTPs. When a position is settled at some point in the future, the IRS may assess interest and penalties on the amount settled, depending on what the specific position is. As such, taxpayers are required to accrue interest and penalties annually as part of their UTP process. For example, here's a simple roll-forward schedule. Let's assume one position that the taxpayer has taken on its 2017, 2018, 2019, 2020, and now on its 2021 tax return. In the current year 2021, the company would record a liability for any changes with respect to its cumulative position. Coming into the year, their balance is $28 million, and then we're going to layer on the 2021 impact. There would be an increase to add the 2021 benefit. Assume here it's an $8 million benefit measured at the full 100%. So we're going to put a liability up for that full benefit. Plus an increase would occur for additional annual interest assessed on prior open years. So this is the prior years of 2019, 2020, and in this case, 2021, and penalties that may be incurred, less any current audit settlements, and finally statute closings. Let's add to our assumptions that the statute of limitations for this position closed for tax year 2017, and the company also had an IRS audit in which they settled on an agreement for 2018 whereby the company did not sustain the benefit. The current year balance would include a reduction for both the statute closing and settlement. The company should also at that time reassess based on audit settlement whether any of the 2019 to 2021 tax year UTPs should be remeasured. This gives an ending balance of $24.726 million after taking into account 2021's new UTPs coming off for 2017, 2018, and additional interest being added. Tracking by position is important for many reasons. The jurisdiction or jurisdictions where the tax position is filed determines the relevant tax authority involved. Is it a U.S. issue, state issue, or maybe a foreign subsidiary? Depending on jurisdiction, certain tax positions may have different statutes of limitations to be considered. Additionally, jurisdiction impacts which tax rate to use for the UTP liability, what is the appropriate rate of interest to use each year, and what penalty may or may not apply to an underpayment of tax later assessed. All of these differences need to be accounted for in determining adjustments to a company's UTP liability. When annually assessing statute of limitations, not only jurisdictions should be considered. Failure to file certain forms, disclosures with a tax return may extend the statute of limitations indefinitely. And if a position is taken in a year where an NOL, net operating loss, is generated or utilized, this may also extend the statute for the tax return year. Thus, tracking by position by year becomes very granular in process. Only a high-level reconciliation of UTPs for the consolidated group is required to be disclosed in audited financials under U.S. GAAP. That being said, transparency into company UTPs has heightened over the past few years. For corporations that issue or included in audited financials and have assets that equal or exceed $10 million, the IRS requires that a schedule UTP is attached annually to U.S. Form 1120. This schedule asks for very detailed information about each tax position that affects the U.S. federal income tax liability. In summary, UTP should be analyzed annually, not only to identify new UTPs for the year, but to account for the many changes that occurred during the year with respect to prior UTPs and changes in facts and circumstances. If you found the video useful, please feel free to add comments below or consider subscribing for additional videos as they are published.